Stocks were pounded once again as investors worried that Europe's debt crisis could spread around the world and halt the U.S. recovery. The market weakened as new unemployment claims and the leading economic indicators both came in weaker than expected.
What's going on in Europe is the primary driver, but we saw a little bit of a dip in leading indicators. We saw some nervousness in terms of the jobs numbers.
Motion is agreed to.
News that the Senate ended debate on a financial regulation measure accelerated selling in the final minutes of the day, pushing the Dow Industrials down even further. President Obama hailed the vote as a step toward ending abusive practices on Wall Street.
Over the last year, the financial industry has repeatedly tried to end this reform with hordes of lobbyists and millions of dollars in ads. And when they couldn't kill it, they tried to water it down with special interest loopholes and carve-outs aimed at undermining real change. Today, I think it's fair to say that these efforts have failed.
The Dow ended the session down 376 points at 10,068, its biggest one-day drop since February 2009. The Standard & Poor's 500 is down nearly 12% from its high last month. Stocks had risen sharply from their lows during the financial crisis. So is this a normal pullback or something more threatening?
Corrections are a normal and healthy part of investing. But when you have the correction being driven by something as uncertain as this sovereign credit problem, this could easily morph from a garden variety correction to something much more serious.
The euro has been a huge factor in steering the market, falling significantly since last Thanksgiving when it was valued at $1.50. It did manage to rise in late trading Thursday to $1.25, but some analysts are concerned that it could reach parity with the dollar by the end of the year.
And it reflects, a budding credit crunch in Europe. And so that's why traders around the world are really paying attention to this.
The market's slide over the past 4 weeks has been a painful reminder of the turbulent days during the financial crisis.
The correction that we're experiencing is probably healthy for the market, but I'm not sure it's completely done yet. I think the European authorities have to take a number of steps to calm the waters, and that we could see a bit more volatility and perhaps a bit more selling before this is through.
The mood on Wall Street now suggests that more investors are grasping at the possibility the U.S. recovery could be in jeopardy. The fear is now the stock market's big rebound since March 2009 may have been overdone. Mark Hamrick, The Associated Press.